Hello, everyone. Welcome to FinServ Now. I'm your host for today, Deshaun Turner. So sorry, I just echoed. Hi again. I'm welcome to FinServ Now. I'm your host for today, Deshaun Turner. I know you're all eagerly awaiting to hear from our speaker today, Daren Blomquist of auction.com. So let me tell you a little bit about Daren, and then we're going to jump right into the discussion. Daren is Vice President of Market Economics at auction.com. In his role, he analyzes and forecasts complex macro and microeconomic data trends within the marketplace and industry to provide value to both buyers and sellers using the auction.com platform. Let's all welcome Daren Blomquist. Hi, Daren.
Hi, Deshaun.
How are you?
Here I am. I'm doing great. Thank you so much for having me today.
Good. I'm so excited to hear about how the housing market is going to fare this year. But before we get started, if you, our viewers, have any questions, please put them in the chat box. We will make sure we have time at the end to address them. So without further ado, all right, Daren, let's take it away.
All right. Get the screen sharing up and going.
All right.
And here we go. See my screen now?
Yes, we can see. Can you put in presentation mode?
Yeah. Thought I had that, but. How's that?
Perfect.
All right. Thank you so much. And again, great to be here and sharing some of what we're seeing in the marketplace with all of you out there. So I've been with auction.com about 3 years now, and I know we're a big supporter for the council, and glad to be doing that. And but today, I'm really going to be focused on what we're seeing in the marketplace, using some of our own data, and then also using wider marketplace data to talk about really what we see happening in the real estate market, housing market in 2022, but also specifically really narrowing down to the distress market. And what we do at auction.com is really at the end of that servicing spectrum where the property is disposed of, and that distress disposition step. And so that's what we're looking at very carefully, and I'll eventually kind of get down to that tip of the spear that we're looking at, and hopefully this will be helpful for whether you're in that distress disposition space specifically, or just dealing with other parts of that puzzle in getting to the distress disposition. So I have quite a bit of data here. I don't know if I mentioned this to Deshaun, but I'm happy to share the slides as well with your audience if anybody wants to dig deeper into these or just have them as a reference point. So and also if you have questions, as Deshaun mentioned during the presentation, as I'm going through a specific slide, feel free to throw that into the chat, and then we will try to get to those at the end. If we don't have time, happy to answer those even after the fact as well. So what we're starting, I'm going to start here with a very broad view of the marketplace, which is the jobs market, which impacts the real estate market quite a bit, and especially the distressed real estate market a lot. And what we're seeing in the jobs market is a recovery that's been stronger than many people expected. I was looking at some slides I had created back in June 2020, just when we were starting to see the impacts of the pandemic. And a lot of economists at that point were predicting that unemployment rates could get as high as 20 to 30%. We never saw that. We saw unemployment rate get up to 15%. And I don't even have that unemployment on this slide anymore because it's not really newsworthy anymore. We're down to 3.9% unemployment. And so that's really good news for the real estate market and for the stress market, because you do see that unemployment is traditionally and historically the biggest driver of foreclosures, of delinquency of foreclosure. And that unemployment rate really has recovered back to pre-pandemic levels. I mean, technically, pre-pandemic, we were at 3.5%. We're at 3.9% now, so not too far off. And really, 3.9% is lower than the long-term average of kind of historic normal employment. We do still have 2.9 million fewer people employed, and the reason that we have such a low employment rate is you do have a low labor force participation rate. And that has to do with the graph on the right-hand side there, is that people are not coming back to the labor force as quickly, but it's more voluntarily. And what you see there is the job openings in red is there's well over 10 million job openings, while there's under more like 7 million unemployed, 6 to 7 million unemployed. And so what that means is there's about over 4 million more job openings than there are people unemployed, which is great if you're a worker out there. But what it means for businesses is they're going to have to start to raise wages to attract workers back to employment. And we're seeing some of that. And that I mention that because that's an important piece that I want to get to next, which is that's going to continue to put, those rising wages are going to continue to put upward pressure on inflation. One other thing I wanted, and I'll talk about that in a second. One other thing I wanted to talk about here is on the left-hand side is, although the job market has recovered very well, the one piece of it that we're keeping an eye on and that does impact the distress market is that green line, which is the number of unemployed for 27 weeks and over. That number has come down as well, but not as quickly. There's still actually 887,000 folks more in that category than there were prior to the pandemic. And so there's still a large number of people who have been unemployed for a long period of time, excuse me. And so that is a concern. And those are folks who are in the labor force. They're trying to find a job. It doesn't have to do with that labor force participation rate that I talked about, where they're not even participating, but they are actually looking for a job but unemployed. So that is a concern. And those are the type of folks who, when their forbearance ends, when the moratorium is over, which it is over now, that they don't, if they still don't have that job, that means that they're going to struggle to get back on their mortgage payments. So I mentioned inflation, and that's really a big concern. And at this point, I'm not as concerned about I don't want to sound callous or anything, about the pandemic's impact on the housing market. I'm more concerned about the response to the pandemic's impact on the housing market. And the response to the pandemic was very successful in terms of preventing a huge shock to the economy and a huge shock to the housing market. However, what it has done is created this inflation risk because of all the stimulus thrown into the economy and into the housing market indirectly in the form of lower interest rates by the government. We are seeing this skyrocketing inflation, and just last week, 7% year-over-year inflation using the Consumer Price Index in December 2021. That's the highest since June 1982, so based almost a 40-year high. And we do see on the right-hand side there, the shaded little bars are the recessions, and then the the darker shaded bars is inflation. And so we do tend to see, as inflation spikes, a lot of times that is associated with recession. And the Federal Reserve's typical response, at least over the last 40 years, has been, when inflation is becoming a problem, is to push, hopefully not push an economy into recession, but push it, the economy closer to recession, to just cool down the economy and not let that inflation spiral out of control. And so, again, getting back to that theme of one of the things I'm concerned of now is not that the pandemic itself is going to cause a recession, which it did cause a very short recession, as you can see there on the far right of the right-hand graph. However, I'm concerned now more about the potential recession down the road that could result from the response to this inflation problem. So that's a theme I just did want to hit on. And then diving down into the housing market more specifically and connecting it to that inflation piece is in response to the inflation, we're already seeing the Federal Reserve talk about raising interest rates, which will likely, the interest rates they have control over will likely put upward pressure on mortgage rates. And we'll see mortgage rates go up on housing, which will make housing less affordable. We're already in a place where housing has become very unaffordable in the wake of the pandemic, thanks to these rapidly rising home prices. If you see on the left-hand side there, I don't have the home price appreciation. What I have on the blue bars is based on the interest rate, your mortgage rate, how much, if you're buying the same priced house today that you were a year ago, how much more would your payment be? And we're seeing those blue bars in, 15 to 20% higher mortgage payment on the same priced house this year compared to last year. And wages are going up 5% or less, or have been this year. And so that's creating a greater affordability crunch, and we would see that heightened if interest rates go up. And so I think what we'll likely see in 2022 is those interest rates will go up, which will further cool housing demand. On the right-hand side, we're already seeing, now home price appreciation is still very strong at around 15%. However, it has been cooling. It hit as high as almost 25% back in the summer of 21. And so we're already starting to see some slight signs of cooling demand for housing, and I think that will continue. I don't think I have it in this deck, but we're seeing, if you look at consumer sentiment surveys, you're seeing a lot of signs that a lot of consumers considered it a bad time to buy a home, and so that's not gonna be good for home buying demand in 22. The one thing that's saving the housing market is this low supply, and so we're not in a situation where that demand, if the demand falls off, there's still not a lot of supply, and so we're not going to have this huge oversupply problem. But I do think cooling demand will slow down home price appreciation, and that is, the implication on the distress market there is that homeowners who maybe are in trouble and are coming out of forbearance, again, tying back to maybe somebody who's in that situation of being unemployed for 27 weeks or longer and still not recovered their job and coming out of forbearance, as home price appreciation slows down, they may not have as much of a cushion in home equity as they maybe thought they did. And we'll talk about that a little bit more. This slide is just showing, this is a little bit outdated, but it's back from September, but we are seeing some of the hottest markets in the country starting to cool off. And so I think that's a harbinger of more of this thing to come. Not a crash or anything like that in 2022, but just a cooling housing market. Places like Boise and Provo, Utah, Denver, Colorado, Salt Lake City, there's a high percentage there of listings with price reductions, over 50%. And we're seeing fewer multiple bidders, fewer what's called bidding wars by Redfin there on the right-hand side. I did include some of our data there too, the blue line. We're still seeing a very high percentage of bidding wars on our site, which is somewhat expected given the fact that we are an auction site, and so inherently there's going to be a lot of bidding wars, but 80 to 90% of the REO properties on our site are getting multiple bidders, which is of course good for the sellers, the servicers who are selling these properties. So still a lot of strong demand, but some slight signs of cooling, and I think that's going to continue in 2022. And then the implication of this hot housing market that we've had and the high home price appreciation is that homeowners do have a lot of equity, and real estate net worth is at an all-time high, and actually the third quarter numbers have come out now. I have the second quarter there, and it's even higher. It's a new record high in the third quarter. And the equity is also at an all-time high. And specifically Black Knight there on the right-hand side looks at tappable equity, which is equity above of more than 20% equity basically in the home. And it's an astounding amount, 9.2 trillion in this tappable equity, which is up 37% from a year ago. So homeowners have a lot of that, at least on paper, equity. And that of course applies to the distressed homeowner who may need to leverage that equity to avoid foreclosure. And so that's really good news for anyone worried about a foreclosure wave caused by the pandemic, which, as you'll see, I don't see that happening. And we'll get into more detail. Now, I would say there's one counter. There's this equity, but I would caution against considering home equity as a panacea for foreclosure prevention. And these graphs, again from Black Knight, which are actually very helpful, show that particularly the right-hand side graph there shows that that's the roll rate from foreclosure start to foreclosure completion, basically when the property is brought to foreclosure auction. And you do see that equity has an impact on that. They have it broken down by equity category, with the highest equity category being that lightest line at the bottom. But what stands out to me is that, and you have to, and they say this here in the small print as well, you really have to focus in at around 2015 to 2018, because that's the year of the foreclosure start. And because of the foreclosure moratorium, many of the properties that started foreclosure in even 2019, but especially 2020 and 21, are not moving through because of the foreclosure moratorium. But anyway, if you focus in on that 2015 to 2018 period, consistently, even those homes with a lot of equity, about 30% of them that start foreclosure are actually being foreclosed on. So it's not a cure-all. Home equity is not a cure-all that helps everybody avoid foreclosure. And there's a huge conversation around why that is, but it is a reality here in the data. And so I don't think we can assume that just because people have equity, they're going to avoid foreclosure, although that is going to help a lot. All right, and we have some of our own data that shows this as well, is that folks who are homes that are making it to foreclosure auction on our platform, many of them are actually generating these what's called surplus funds. So they sell at the foreclosure auction for more than the total debt owed to the foreclosing lender, which indicates they have equity. And the homeowner may not have realized it, the servicer may not have even realized it, but we're showing 43% generated these surplus funds. Now, a lot of times because of second loans and things like that, the total debt owed is not comprehensive of all the debt collateralized by the property. And so we built in a 20% equity cushion. But even if you do that and say, the percent of auctions that sold for at least 20% above what was the total debt, we're still seeing 20% of those have that kind of tappable equity when they're sold at foreclosure auction. Now, the good news, by the way, with this is those surplus funds do go back to the homeowner after the lender is paid and any junior lien holders are paid. So there is kind of a protection for that equity and that's why we encourage a robust, transparent foreclosure marketplace like ours, because that does at least protect that homeowner equity. If they don't know they have it, or for whatever reason it makes it foreclosure, and they still can walk away with a check or some money for that property, even if it was foreclosed on, if that's generated. But this is happening about 20% of the time, at least on our marketplace where those homeowners have equity. Now, one of the things we're doing to try to even further protect this homeowner equity is we've started a pilot program called pre-foreclosure auctions. It's called a market validation program. But basically, if a homeowner is in pre-foreclosure, the servicer, in cooperation with the homeowner, can, if the homeowner is in default, can of course list the property on the MLS, but also list it up for auction on our site. And what we're seeing is when they do that, we're seeing about half of those properties up for auction are getting a higher offer than on the MLS. And when they are higher than the MLS, it's about $39,000 higher on average, winning bid that we're getting on our site compared to the MLS, and it's about $20,000 above the lender reserve, which is a proxy for how much is owed on the debt. So these pre-foreclosure auctions, I think, could become, and just pre-foreclosure sales in general, could become a great way for homeowners to avoid foreclosure, but also protect that equity that they have in the property. And I've actually talked to some of these homeowners who didn't think they had equity, because we're trying to figure out why they didn't just sell in the MLS, but they didn't realize that they had equity. So this is some good news if homeowners take advantage of it. Now I want to jump into switching gears just a little bit, just looking ahead at 2022 in terms of foreclosure volume. And what I've done here is I've taken numbers from Black Knight, which are seriously delinquent loans, and those are about 1.2 million now, or the latest data, which is November 21. But we're forecasting, if the current rate of decrease continues with seriously delinquent loans, they'll be at 1.1 million by January. And so if historically seriously delinquency is a precursor to foreclosure, and so if we look at that and look at the historical rates, and scenario one, if we look at the historical rates in 2019 and even years pretty consistently before 2019, at the beginning of the year, if you took the number of seriously delinquent loans and times it by 25%, that would be how many completed foreclosures there would be for the year. It's kind of a rough way of looking at it, but it's actually pretty effective. And so if we use that 25% of 1.1 million, we get about 272,000 foreclosures. Now, I actually believe that's probably not likely. And by the way, just to put this in context, there were 191,000 foreclosures in 2019. So this would be above that for sure. But it would be about the level that we were seeing in 2017, 277,000. However, I think because of the environment we're in, where there's a lot of protection for homeowners and a lot of energy and resources and money being directed at homeowners to avoid foreclosure, it's more likely we won't see 25% of those SDQ go into foreclosure. We'll see more of a rate that we've been seeing over the past couple of years. And if I take the average of 2019 to 2021, that roll rate is more like 13%. And if we see that, we would see more in the range of 139,000. I know that's a huge range, but I do want to emphasize that I think it's going to be much closer to the 139,000 foreclosures completed in 2022, as opposed to that 272,000. But that is kind of the high end of the spectrum. And again, to put it in perspective, if we hit that 139,000, it would be much lower than even pre-pandemic levels, which is good news that, again, we're not going to see this foreclosure wave. Even in the scenario one, we would see heightened foreclosures, but it would be at the, we're not talking 2010 levels when there were over 1 million foreclosures. we're talking 2017 levels. Here's a longer term forecast that we have that basically shows, we do show foreclosure activity rising over the next few years. And of course, there's a lot of caveats on this. A lot of things could change in the next few years, but our best estimate using different mathematical models and data is that we will see foreclosure activity gradually rise over the next few years and back to about 2017, 2016 levels. But that 2025 is likely the height of this, and we would see the numbers flatten out or go down from there. But as you can see, we were definitely what I would call artificially low, maybe that's the wrong term, in 2020 and 21. Those are actual numbers now because of the forbearance and moratorium has held back some foreclosures that otherwise would have happened in a normal market. And so some of those are going to be coming back. Now, so last couple of slides I've been talking about forecast. This is going to shift. Okay, so what's really happening so far? What's the latest data? And this is FHA data that we are seeing since the moratorium ended in July, the foreclosure moratorium. We are seeing FHA foreclosure activity increase. Now, it's still well below pre-pandemic levels. But if you look at the percentage increases, it looks huge. There's a 76% increase from August to July in foreclosure inventory, and July was when the moratorium ended. But then if you look at it relative to pre-pandemic levels there, those blue bars on the left-hand side, we're still, even though you see that big jump, we are still well below those pre-pandemic levels. But there is an impact. I mean, once the moratorium is over and as forbearance, more people exit forbearance, we do expect to see a gradual, what I would call a gradually rising tide of foreclosures closer back to pre-pandemic levels over the course of the year. That's FHA. This is looking at by state. There is a difference because of the different protections in place by state. We are seeing different levels of kind of return of foreclosures. And so the green is where we're tending to see foreclosures come back a little bit more quickly. And the blue is where foreclosures are coming back a little bit more slowly. And this is FHA data. And this is looking at, there was a foreclosure inventory for FHA. This is from HUD's Neighborhood Watch website. And they did increase by 33,000 from July 31st to September 30th, those for FHA foreclosure inventory. And actually, even since then, they've increased even more. They're up to close to 90,000 FHA loans in foreclosure as of December. I just checked yesterday, the data came out, didn't have time to include it in the slide. So we are seeing these big increases, but it's still below pre-pandemic levels is what I want to emphasize here as this increase happens. But you do tend to see some of the middle of the country, but also California and Florida with some of the biggest returns in foreclosure inventory. This is data from our own platform, auction.com. It's kind of a similar thing, but I think this maybe shows it a little bit more clearly. I'm comparing our levels of completed foreclosure auctions to Q3 2019 is the benchmark. And so you see that's 100%. But when in Q2 of 2020, when the pandemic first hit, we were only at 4% of those Q3 2019 volumes. We have gradually, as things have gone on, we've gradually seen that increase. And then we did see in the fourth quarter the highest percentage of volume, or the highest percentage of volume relative to pre-pandemic levels that we've seen so far in the pandemic. So this is that gradually rising tide that I'm talking about. But again, it's still not even close. We're still 62% below pre-pandemic levels is the foreclosure auction volume that we are seeing. And here's those numbers by state. Similar to the FHA data, you see in the middle of the country, along with California, which is interesting. Seeing but the percentages here are the percentage of pre-pandemic volume. You do see North Dakota, there's a little bit of an outlier, but the numbers are very small there, so it's a little bit, you got to take that with a little bit of a grain of salt, because even though they're 183% of their pre-pandemic levels, it's extremely low volume there. But places like Oklahoma at 108%, that's higher volume. Indiana, 86% of pre-pandemic levels, that's a little bit higher volume as well. Those are some of the states where we're seeing foreclosure return closer to pre-pandemic levels faster. I'll go through some of these next slides a little bit quicker, but certainly, as I said, you're welcome to have this presentation afterward to dig into these. But this is the type of foreclosure volume that we're seeing. We're seeing it pretty split. The size of the circles there on the left is the percentage of total volume, and so GSEs, FHA, private portfolios are roughly the same percentage, roughly each about a third or so of all of our volume. However, the darker green there, FHA and private portfolio, that's where we see the 36% of pre-pandemic levels and 37% of pre-pandemic levels. Those are the loan types that we're seeing return a little bit faster back to pre-pandemic levels as opposed to the GSE loans. On the right-hand side, it's broken down by value range, and generally speaking, we're seeing higher value properties making it to foreclosure, and this has to do also with the rising tide of the housing market is helping that as well. Occupancy, now we saw the shift here, especially if you look at the Q4 numbers, the percent in the foreclosure auctions that were presumed occupied. It's a little bit tough to know for sure if a property is occupied or not when it goes to foreclosure, but if it's known to be vacant, we know that. And we did see a shift once the moratorium ended in the percentage that were occupied, because that moratorium had to do with or did have the exemption for vacant and abandoned properties. And so now we're seeing that that's ended. There are a higher percentage that we believe may be occupied that are making it to foreclosure auction. But whereas early on in the pandemic, it was, as you see, that 165% increase in those known to be vacant. Most of the properties being foreclosed on early on in the pandemic before the moratorium ended were vacant and abandoned. The earlier slide I showed you was foreclosure auction volume. This is REO auction volume. And if you remember, with foreclosure auction volume, we've seen that return to 38% of pre-pandemic levels. REOs still are at 17% of pre-pandemic levels. So we're it makes sense that we haven't recovered as quickly on the REO side because the foreclosure is the first event to happen, and then if it doesn't sell to a third party, it goes to REO. So we do expect this to eventually rise. We did see a slight rise in the fourth quarter to 17% of pre-pandemic levels, but we expect this to somewhat mirror what we were seeing with the foreclosure auction volume. Although we are seeing a much higher percentage sell at foreclosure auction, so fewer are making it through to REO. We are seeing a higher percentage of REOs now, similar to foreclosures, that are occupied. In the third quarter of this year, there were almost half, 48%, that were brought to auction were vacant. So that means 52% were occupied. So we're seeing that slightly trend higher and lower percentage that are vacant as the eviction. Part of that has to do with the eviction moratorium going away. And then I do want to, the last shift here in my presentation, the last few slides here are really focused on, okay, we know that I would say that the response to the pandemic in terms of the servicing industry has really been a resoundingly successful. I wouldn't say it's been a complete success, but a lot of the lessons learned during the last recession were applied in the wake of the pandemic. And so what you saw is a lot of unnecessary foreclosures that were prevented. And as a result, we're not seeing this wave of foreclosures. However, as I've talked about the last few slides, there are a certain number of foreclosures that are going to return, and that would have probably happened whether or not there was a pandemic or not. And that's been part of the ecosystem of the real estate market that relies on financing forever, is that you do have some properties, some mortgages that fail, and we're seeing some of those return. And so the question here I want to address with these last few slides is, that's my timer, so I'm almost out of time here. But okay, so we know these are going to happen. What are some of the best practices we can put into place that will make sure that these dispositions, these distressed dispositions, are happening in a responsible way, the most responsible way possible? And one of the things that we're seeing is basically what I'm trying to communicate with this first slide is, generally speaking, if you're looking to return these distressed properties, or I shouldn't maybe say return, but get these properties, distressed properties that are somewhat inevitable happening, back into the hands of owner occupants, rather than the big investors who scooped up a lot of foreclosures in the wake of the last recession and turned them into rentals. So if the goal, which I think is a worthy goal, and the goal of a lot of folks out there, is to, as much as possible, get these properties into the hands of owner occupants to encourage home ownership, encourage wealth building, generational wealth building. I would argue, based on this data, this is from our platform, that one of the best ways to do that is to sell more to investors at the foreclosure auction. That may sound counterintuitive. That may sound like, oh, that's exactly what happened last time. But what we're seeing is the type of investors now at foreclosure auction are not the big institutional buyers. The foreclosure auction actually has become too competitive, which is a good thing for those bigger institutional investors. They were coming in, swooping in, and wanting to get really deep discounts. And because the foreclosure auction has become competitive, transparent, at least the ones done on our platform, I would say, just a little plug, is that we see that it's mostly going to small local investors, even nonprofits sometimes, that are mostly turning these properties around, rehabbing them, and selling them then to owner occupants. So these numbers here in blue, the 71% are the percentage of properties purchased at foreclosure auction and then resold, and then of those resales, what percent sold to owner occupants? We're showing 71%. And this is over a period of 2018 to 2021, just to give you a context here, that are reselling to owner occupants. And we compare that in the gray to if it doesn't sell at foreclosure auction, it goes back to the servicer, the lender, and then they resell it. What we're seeing is only 49% of those are owner occupied. Many of those are actually ending up selling to investors anyway, not directly to owner occupants. And we broke this down by low income tracts and minority tracts, and we're seeing similar, slightly lower, but similar home ownership rates when the property is sold at foreclosure auction, those higher home ownership rates. So we think that's one thing, is the more a servicer can sell at foreclosure auction rather than take back the property as an REO, the higher the home ownership rate will be, the end home ownership rate will be. And then another thing that we're showing, and so that's the goal of home ownership. Another kind of goal that I think a lot of servicers and policymakers are looking at is, okay, we want to add value. We want to improve neighborhoods, not cause more blight in neighborhoods with these distressed dispositions that are going on. And what we're seeing again is when a property sells to a third party at foreclosure sale, rather than reverting to REO, we typically see a quicker recovery of value in the properties. And there's a lot of data here, and it's a little bit tough to explain, but basically on the left-hand side, when a property sells at foreclosure sale, we're seeing within, and I don't think I have it here, but within that property is typically sold within about 221 days. So there's a renovation period that takes place over 221 days. And that property goes from selling at $160,000 at the foreclosure sale because of the condition of the property to selling for $250,000 reselling. And it sells for 97% of its full after repair market value, which is based on an AVM. And so it's recovering most of its value, which is good for the neighborhood. On the right-hand side, what we see when a property goes REO, it actually, what the servicer valued the property at the foreclosure auction was $167,000. It ends up selling as an REO for lower than that. So there's no value recovery taking place there. And that actually takes a little bit longer than those 221 days between those two sales. And so that's just, delaying the process of improving the values in those communities. And then lastly, the objection to the previous slide is, well, you're selling for $250,000. Aren't you gentrifying these areas and causing properties not to be affordable? Excuse me, for homeowners in those markets. And what we're showing is, even at that $250,000 price point, is that's the price to income ratio for those properties is 3.4, excuse me, versus for all properties sold nationwide, we see a price to income ratio of 4.4. And so even these properties that are being renovated and value added are selling at a much more affordable price point relative to the incomes in those markets, in those neighborhoods, is selling at a much more affordable price point. So that's what I've got. And Deshaun, I will hand it back to you.
Thank you so much, Daren, for that, and thank you for an informative forecast for this year. You share valuable insight that I know our audience will use as they prepare for the year ahead. So we have a couple of questions. And remember, if you have any questions, please put them in the chat box and we will answer. Our first question, Daren, how are you determining that you get more on auction.com than MLS? Are they listed as short sales on MLS and on auction.com?
Yes, great question. And I do want to point out, we're not always higher than the MLS, but we act as a great counter to the MLS, or validation. Some of our buyers may not be looking on the MLS, but about half the time we get a higher offer. And the way that we know that is the property is being listed on the MLS and up for auction at the same time. And so we're able to compare the highest offer on the MLS to what the highest bid that we're getting on auction.com.
Another question, what, if any, impact do you anticipate to home price appreciation and affordability over the course of 2022? For example, will HPA continue to slow or flatten, et cetera?
My best guess is that it will slow or flatten. And I would say slow more than flatten in 2022 because of the rising, it looks more and more like mortgage rates are going to go up, which will cause affordability to worsen and homes to become more expensive, even without a price rise. So I do believe that will happen. I actually think that's the best scenario. I think if we continue to see 15 to 20% increases in home prices, in 2022, we would be set up for another bubble, and eventually that bubble would burst. So I think the most likely scenario and the best scenario for the housing market is that we see price appreciation slowing in 2022. There is some risk if interest rates go up too fast, that you could see a slight correction, more like in 23 as opposed to 22. But I think right now the most likely scenario is slowing home price appreciation down to maybe 3 to 5% by the end of next year, as opposed to the 15% that we're seeing right now.
Got it. Will auction.com continue to sell homes at courthouse?
Yes, so that's the foreclosure auctions I talked about there, and so those are that's a big part of our business, and so we account for about 40 to 50% of those auctions, those courthouse auctions across the country. We are innovating. What we found is that, and I didn't mention this, but if you want to get these properties into the hands of more owner occupants, as I talked about, one way to do that is with technology, because the courthouse auctions are based on laws that were written 150 years ago and don't take into account technology. And so a person who wants to buy a home themselves as an owner occupant is very unlikely to trek down to the courthouse, go to the in-person auction themselves, let alone come up with the cash to buy at the auction. And so we're implementing technology to try to get around that and help more owner occupants, and also these local community developer buyers who are doing a lot of good in their communities to buy it at the auction. Anyway, that's a little bit of a tangent, but yes, we are doing those. But it's really exciting to see that we have this remote bid where people can actually bid on their mobile phone and not have to be there in person at the courthouse to bid on those auctions. And we're seeing that have a lot of positive effect.
We have one more question that came in. What percentage of homes sold at FC sale with go back to banks or servicers?
Yeah, that's a great question. Right now, it is around 40%. So 60% actually sell to a third-party buyer, and 40% go back to the servicer or lender. That is, if you know your history of these types of things, that actually is a complete reverse. Before the pandemic, we were seeing more of the reverse, like about under 40% were selling to third-party buyers, and over 60% were going back to the servicer. During the pandemic, just like a lot of other things shifted in the economy and the real estate market, we saw a huge shift there. There was, in part because all of a sudden the number of foreclosure auctions shrunk precipitously to a very small number. But even as that number has grown, has gradually increased, we're seeing those rates hold around 55 to 60% of the sales are going to third-party buyers, which is why I did mention while we are expecting REO volume to pick up, it's not going to pick up as quickly as foreclosure volume, because fewer of those properties that go to foreclosure auction are actually making it back to REO.
If that is all the questions, then let's go ahead and land this plane. I would like to thank Daren again for your insight into the economic and housing markets for this year. We really appreciate you so much for doing this for us. I would also like to thank you, our audience, for tuning in. So please stay tuned for announcements for our next FinServ Now. Also, we are planning some great things for CIFS in 2022. So please make sure you're subscribed to our quarterly CIFS newsletter and look for special announcements in your email. And also, please visit councilforinclusion.org for all information as well. That is it for us today. And thank you again for joining us for FinServ Now, and see you soon.